Hi everybody, this is Thomas with the third quarter market summary. So let's dive right in. As you can see from the first slide, these are the four major categories of global stocks. U.S. market up just a tiny bit, and the rest of the categories were all down, with bonds up a little bit. Looking at the news, it was a real mix with some political news that was negative, the Ebola news, but a lot of the economic news was positive. World asset classes were almost all negative. The U.S. was up a little bit, but almost every other asset class was down, with the Russell 200 or 2000 value down the most. This is small cap value. We're overweighted in this, so when this performs poorly, it has a drag on our performance. In the U.S., this is how all the categories, with large cap up a little bit, most of the other categories down. And these are the period returns. Small cap is suffering in the short term, doing decent over the long term. International developed, same story. Small cap is doing poorly over the year so far, and in the quarter was down pretty significantly. But over time, small cap's doing okay. Emerging markets, we just have a little bit in emerging markets. It's 11% of global assets, and not doing so bad in the small cap, large cap area. But and small cap doing okay in both categories of regular small cap and small cap value in emerging markets. And here's the country performance. Only the U.S. managed to eke out a tiny fraction of a gain. Pretty negative all across the world as global events overwhelmed economic news and sellers overwhelmed buyers, and we had a negative period in the developed world. A little bit different in emerging markets. We had some rallies in some countries, a little less than half and a little more than half were down, some very significantly. That's how the countries break down. And in commodities, also very negative. Sometimes commodities can be a leading indicator as everyone's buying less stuff they need for factories and manufacturing. A few categories up, but most of the categories down. We have a very small gold position for aggressive clients that we put on a couple of weeks ago. We took it off in the last several days and made a decent little profit in that. We're going to try and expand our tactical trading of special situations. And fixed income, the 10-year bond is now at about 2.5%. 30-year bond's a little bit higher. Bond yields for other types of bonds and bond returns over the short term and the long term. The long-term bond was down about 13% last year when interest rates rose. Interest rates are falling at the moment, and so bonds are enjoying yields plus capital gains. And then here's an editorial about the CAPE ratio, the Shiller index that a lot of people follow, and whether it can be a good timing signal. We actually disagree slightly with DFA. I think they're right that timing the market using this only is not helpful, but it does go into our thinking about whether we're leaning one way or the other. We just don't take as big a risk when we are betting on the direction of the market. We use options, and so that when we're wrong, we do underperform, but it's a tiny fraction of what happens when you take all your money or a lot of your money out of the market. So I encourage you to read this. DFA has always got some good editorials. And that's about it for the summary. If you've got any questions, you can give us a call anytime. Thanks. Bye-bye.